What if the most powerful financial institution in the world was never designed to answer to the people it governs? What if the decisions that determine your mortgage, your savings, your job, even the price of bread were made by a small group of unelected technocrats inside a marble building that most citizens have never entered? The Federal Reserve was not voted into existence by the public. It was engineered in secrecy, in the winter of 1910, on a remote island off the coast of Georgia called Jekyll Island. There, behind closed doors, a handful of bankers and politicians wrote a blueprint for a system that would centralize money itself, one that promised stability but guaranteed control. They didn't call it a government agency, they called it a Federal Reserve System. And that single word system is what separates democracy from design. For more than a century, Americans have been taught that the Fed exists to keep the economy stable, to fight inflation, to create jobs. But the truth is simpler, colder, and far more consequential. The Fed's real power comes not from policy, but from balance sheet manipulation. A ledger that now exceeds $8 trillion. A number so large it defies comprehension. Yet it quietly dictates who gets rescued when markets fall and who gets crushed when credit dries up. Every trillion on that sheet represents a decision, a favor extended to banks, corporations, or governments, all made without a single vote cast by the people who will pay for it in the end. Think about that for a moment. The Central Bank of the United States creates money with a keystroke. It buys government debt and mortgage-backed securities, injecting liquidity where it chooses and starving sectors it deems overheated. The president can be voted out, Congress can be replaced, but the Federal Reserve remains unelected, unfired, untouched, the permanent arbiter of credit and crisis. When markets collapsed in 2020, it was the Fed that stepped in with trillions of dollars, not Congress. When regional banks fell in 2023, the Fed didn't wait for laws, it opened facilities overnight. Power on demand, beyond debate. And yet, most people still believe the Fed is a public servant acting for the greater good. They don't see the cost of that intervention, the distortion of risk, the transfer of wealth from savers to speculators, the illusion of stability built on debt. Every time the Fed expands its balance sheet, it buys the future with the present, mortgaging tomorrow to silence panic today. This isn't a theory, it's accounting. And it's all there in the numbers. You were taught that central banks exist to serve the people. But what if that was the greatest illusion of modern finance? What if the Fed does not serve democracy at all, but the stability of a system that keeps it untouchable? Because in the world of money, power is never about what they show you, it's about what they hide. And the $8 trillion they hold isn't just liquidity, it's leverage over every living breath of the economy. How did a nation born from a revolution against financial tyranny end up with the most powerful, unelected central bank in the world? To understand the Federal Reserve, you have to go back to a time when America was deeply allergic to the idea of centralized financial power. The Founding Fathers had fought a war partly against the tyranny of debt and the financial games played by empires. In the 18th century, the very word bank was suspicious. It was linked to monarchy, corruption, and European control. This suspicion led to two failed experiments: the First Bank of the United States in 1791 and the Second Bank in 1816. Congress chartered both, but political backlash ultimately destroyed them. Remember Andrew Jackson's famous crusade in the 1830s? When he vowed to kill the bank, it wasn't just populist anger, it was a serious warning. Jackson understood a fundamental truth: whoever controls the credit, controls the republic. After his victory, America swore it would never again hand that kind of power to an unelected few. For nearly 80 years, the nation lived without a central bank, and for a while it worked. Until it didn't. The Panic of 1907 was the breaking point. The stock market crashed. Depositors stormed the banks, demanding their money. The entire financial system was on the verge of collapse. And who saved the day? Not an elected official, but a private banker, J.P. Morgan. He personally orchestrated a massive bailout to keep Wall Street from disintegrating. The incident was a national embarrassment. A nation that prided itself on democracy had been rescued by one man's personal checkbook. Clearly, something had to change. Congress promised reform, But the real architects of the solution weren't the voters. They were the very financiers who stood to lose the most if the system remained unstable. In November 1910, a group of the nation's most powerful bankers and politicians gathered in secret. They traveled under code names, disguised as a duck hunting party, to a private club on Jekyll Island, off the coast of Georgia. For 9 days, men like Senator Nelson Aldrich, Paul Warburg of Kuhn, Loeb and Co., and representatives from J.P. Morgan and National City Bank drafted what would eventually become the Federal Reserve Act. Why all the secrecy? It wasn't just paranoia. It was strategic. If the American public had known that Wall Street bankers were designing the blueprint for the nation's money, the bill would have been dead on arrival. The name itself was a masterpiece of camouflage. Federal Reserve System. Federal implied it was part of the government. Reserve suggested safety and stability. And system cleverly concealed its true structure. When Congress finally passed the act in 1913, very few people realized what had just happened. The power to create money had effectively been privatized, delegated to 12 regional reserve banks, each owned by its member commercial banks. The public was told this was progress, a modern, scientific solution to the chaos of banking panics. But beneath the surface, a quiet transfer of power had occurred. Monetary sovereignty had migrated from elected officials to a committee of appointed technocrats. The members of the Federal Reserve Board would be appointed, not elected. Their terms would outlast presidencies, insulating them from direct political pressure. And their most critical decisions, from setting interest rates to managing the money supply, would require no popular approval. America had traded control for the promise of stability. Now, fast forward a century, and the blueprint from Jekyll Island is still standing, only it's grown into a skyscraper. The numbers tell a stunning story. In 1915, the Fed's balance sheet was just under $700 million. By the Great Depression, it hit $4 billion. Before the 2008 financial crisis, it was around $900 billion. Today, it hovers near an astronomical $8 trillion. That isn't just growth. It's a complete transformation. The Fed no longer just nudges interest rates. It owns entire markets. During the 2020 pandemic, it began purchasing $120 billion of government debt and mortgage-backed securities every single month. It was effectively funding the government's deficits and dictating the price of assets across the economy in real time. Every bond the Fed buys is like a vote not cast by the people, but cast for them, shaping their financial reality without their consent. This brings us to the illusion of independence. The Fed claims to operate free from government pressure, but its actions consistently align with political needs. When the government needs to fund wars or massive spending programs, the Fed is there to buy the debt. When markets teeter on the brink of collapse, it floods the system with liquidity. When inflation gets too hot, it tightens just enough to look disciplined, but rarely enough to truly break the cycle of debt. The result is a strange, symbiotic relationship between Wall Street and Washington. One creates the debt, and the other monetizes it. And somewhere in the middle, the public is told it's all for their own good, to maintain stability and ensure prosperity. From a secret duck hunting trip to an $8 trillion balance sheet, the story of the Fed is the story of how power can shift silently, behind closed doors. It was created to solve the problem of panics, but in doing so, it created a new reality, one where monetary policy has become politics by another name, conducted by an institution that no one ever voted for. Let's take a hard look at the timeline of modern crises. Remember the dot-com bubble? The Fed slashed rates to 1%. After the housing market imploded, it printed trillions of dollars. When the pandemic hit, it promised infinite liquidity. Do you see the pattern? Each time, the supposed cure became the next disease. Interest rates were artificially pushed lower, debt exploded, and the very concept of risk was practically erased from the market. Wall Street didn't just flourish, it boomed. But not because of some great wave of productivity or groundbreaking innovation. No, it was because the cost of money itself was manipulated by policy. When capital is essentially free, financial discipline goes right out the window. People often defend the Fed, saying it's the guardian of employment and stable prices. But let's be honest, that dual mandate has become a convenient shield. The Fed's real, unspoken mandate is systemic survival. Think back to 2019, when the repo market completely froze up. Did the Fed wait for Congress to act? Not a chance. It injected hundreds of billions of dollars overnight. Fast forward to March 2020, when Treasury yields went haywire. The Fed launched unlimited quantitative easing. And in 2023, when regional banks started collapsing, it created the Bank Term Funding Program. In a matter of days, every single one of these facilities, these massive bailouts, was an exercise of power that no one ever voted for. And yet, because these actions managed to avert widespread panic, they were celebrated. This is exactly how authority entrenches itself, by saving you from the very fire it helped to ignite. Now, let's consider how this immense power impacts democracy itself. When the Fed decides to set interest rates, it's not just a technical adjustment, it's actively picking winners and losers in our economy. High rates punish anyone with debt, from families with mortgages to the government itself. Low rates, on the other hand, reward speculation and people who already own assets. It's a massive wealth redistribution machine, cleverly disguised as monetary policy. But here's the crucial difference. Unlike Congress, the Fed doesn't have to answer to voters. Its language is deliberately opaque. They use terms like forward guidance and balance sheet normalization. They use a wall of technical jargon designed to keep the average person out of the conversation. Transparency without understanding is just another form of secrecy. And because of this, the public debate about the Fed is never really about its fundamental structure. Instead, we argue about the symptoms: inflation, housing costs, jobs, and the stock market. We rarely question the fact that our entire economic system rests on a foundation that completely bypassed democratic design. The central bank that nobody voted for has become the referee, the star player, and the rule writer all at once in the modern economy. Even our elected leaders bow to its authority because they know that monetary reality can crush political promises. A president can announce a plan for growth, but if the Fed decides to tighten its policy, that growth withers and dies. Congress can approve massive spending bills, but if the Fed drains liquidity from the system, that money never actually circulates. We outsourced our monetary sovereignty a long time ago. We just stopped noticing. In today's world, the Fed doesn't just operate as America's central bank. It's effectively the global central bank. Through things like swap lines and dollar liquidity windows, it dictates credit conditions from London to Tokyo. When foreign banks find themselves short on dollars, who do they call? They don't call their own governments. They call the Federal Reserve. This is how the dollar became the world's reserve currency, not through military force, but through a deep-seated dependence on liquidity. America doesn't export manufactured goods like it used to. Now, its primary export is credit. And as long as the rest of the world needs dollars to function, the Fed remains its unofficial governor. But like any empire, this power comes at a cost. When the Fed tightens its belt, emerging markets around the world often crash. When it loosens policy, speculative bubbles pop up everywhere, from real estate to crypto. Global stability is constantly being traded for our domestic comfort. The pattern is crystal clear. Every crisis expands the Fed's authority. Back in 2008, it became the buyer of last resort for mortgages. In 2020, it stepped in to backstop corporate bonds. In 2023, it became the emergency lender for regional banks. Each time, it adds new functions that were never authorized by law. And yet, these moves are never seriously challenged, because the alternative seems to be total collapse. This is the core logic of technocratic power. Act first, justify it later. And in a world hopelessly addicted to easy money, nobody wants to find out what happens when the taps are turned off. History might not repeat itself exactly, but it sure does rhyme on the balance sheets. The very same logic that led to the Fed's creation on Jekyll Island over a century ago, the idea of achieving stability through centralized control, is still the guiding principle today. But control is a fragile illusion. When power is built on trust, and that trust is built on an ever-growing mountain of debt, the entire structure stands only as long as people continue to believe in the paper it is printed on. So the real question isn't whether the Fed can sustain its $8 trillion balance sheet. The real question is how much longer we are all going to pretend that this is normal. Because if history has taught us anything, it's that power granted during a crisis is never given back when things are calm. The central bank that no one voted for has become the one institution that everyone depends on. And that very dependency is the greatest threat of all. There's a moment in every empire when the illusion of control begins to turn on itself. For the Federal Reserve, that moment came not with a crash, but with silence, a quiet admission buried in its own data. When the 2020 pandemic hit, the world held its breath. As economies shut down, the Federal Reserve acted with unprecedented force. In just 4 months, its balance sheet doubled. That's trillions of dollars, conjured into existence, flowing through a maze of programs that no citizen had ever voted for. The headlines framed it as a heroic rescue, a necessary intervention to save us from a new Great Depression. It wasn't to the struggling small businesses on Main Street. The primary beneficiaries were a familiar network, primary dealers, massive hedge funds, and the same megabanks that have been at the center of the financial system since its modern inception. The Fed didn't fail in its mission, it executed it perfectly. Liquidity flowed upward, not outward. It stabilized the financial system by reinforcing the very hierarchy it was supposed to regulate. Then came the quiet confession. In 2021, the Fed's own Inspector General released an audit that should have been front-page news. It revealed that high-ranking officials, including regional presidents, had been actively trading assets that directly benefited from the very policies they were designing and implementing. They were buying stocks, bonds, and exchange-traded funds. While the public was being told to brace for inflation, the architects of the policy were profiting from the medicine they were prescribing. This is the central bank that no one voted for, an institution that had become a marketplace where personal incentives and public duty blurred into an unrecognizable mess. We were told these were the guardians of stability, but guardians rarely grow wealthy from the fires they claim to extinguish. As the market soared to new highs, fueled by this endless stream of liquidity, the real economy limped along. People started to believe that the Fed could prevent any crisis, that as long as the money printer was running, no collapse could ever last. This belief got a name: the Fed put. It became a kind of religion in the financial world. The consequences were profound. Investors stopped truly fearing loss because they believed the Fed would always be there to bail them out. Politicians stopped fearing debt because the central bank was always there to buy it. Even households started to see rising asset prices not as a bubble, but as proof of a genuine recovery. But here's the thing about faith: it's the most expensive form of leverage. Once blind belief replaces sober risk management, a devastating collapse doesn't just become possible, it becomes inevitable. The Fed hadn't just created a financial system, it had created a narrative machine where confidence itself was the only currency that mattered. By 2022, that illusion shattered. The inflation they said was transitory broke through with a vengeance. Prices surged at the fastest pace in 40 years, hitting every family at the grocery store and the gas pump. The same institution that printed trillions to save the system was now forced to try and destroy that demand to save its own credibility. And so, the rate hikes began. They came fast, they were brutal, and they were relentless. In just over a year, interest rates shot up from near zero to over 5%. It was an expensive lie, and the bill was finally coming due. The consequences rippled through everything. The housing market, which had been red hot, froze solid. Promising startups, once fueled by cheap venture capital, withered and died. Governments around the world suddenly found themselves paying massively more just to service their existing debt. Yet, even in this chaos, the Fed's power only deepened. The higher the rates went, the more the world clamored for dollars, strengthening the Fed's grip on the global financial system. Every tightening cycle turned into a dollar trap for other nations. Inside the Fed, a strange paradox was growing. To restore trust, it had to inflict pain. But in inflicting that pain, risked breaking the very system it was sworn to protect. All the while, its balance sheet remained swollen with trillions in assets. The U.S. Treasury kept issuing more and more debt, and foreign buyers, once reliable customers for that debt, started to get nervous. Beneath the calm surface of financial markets, the daily movements of yields and spreads, the fundamental plumbing of the system started to fracture. We saw spikes in critical overnight lending rates. Bank reserves started to fall, and the same emergency levers that were created back in 2020 were being quietly reactivated, one by one. The patient had never truly recovered. The morphine had just been renewed for another round. Then came the twist that almost no one noticed. In early 2023, as regional banks like Silicon Valley Bank started to collapse, the Fed unveiled a new program, the Bank Term Funding Program, or BTF. It sounded technical and boring, but what it did was astonishing. It allowed banks to borrow money from the Fed by using their government bonds as collateral. The catch? They could borrow against the full face value of those bonds, even if those same bonds had lost 30 or 40% of their value on the open market due to the Fed's own rate hikes. Let's be clear about what this was. It was another bailout, wrapped in the impenetrable language of central banking. The Fed wasn't just rescuing depositors, it was rescuing confidence in its own broken system. For all its talk of independence, it could not allow its own interest rate policy to destroy the very institutions it was supposed to supervise. Over $160 billion had been drawn from this new emergency program. The excess reserves in the banking system were shrinking. The reverse repo market, a barometer of excess cash, was collapsing. Liquidity wasn't flowing through the economy, it was fleeing from it, seeking safety in the Fed's labyrinth of programs. The public narrative we were sold was one of normalization, a return to business as usual. But the data said the triage had never ended. The central bank that once promised stability had become the eye of the storm. It was printing money with one hand through programs like the BTF, while tightening financial conditions with the other through high interest rates. It was a contradiction so profound, it bordered on the absurd. And this brings us to the cliffhanger we are all living through right now. What happens when the institution built to save the system becomes the system's single point of failure? What happens when the rescuer's own balance sheet becomes the biggest risk of all? Because if, or when, the next major shock arrives, a rout in the bond market, a global credit freeze, a major sovereign default, the Fed will face a terrifying choice. It can create trillions more dollars, but it cannot print credibility. It can create liquidity, but it cannot create trust. And when that moment comes, the world will finally see the truth that has been hidden in plain sight all along. The central bank that no one voted for never needed our votes at all. It only ever needed our belief. And belief is running out. Ever wonder what makes the Federal Reserve so powerful, so untouchable? It's not just about setting interest rates. That's the headline. The real story, the source of its immense power, is hidden in the plumbing of the global financial system, the invisible channels where money isn't just spent or saved, but created, exchanged, and endlessly recycled. To really understand the Fed, you have to forget the myth that it just sets interest rates and magically controls the economy. The reality is far more intricate. The Fed's control comes from its balance sheet, a set of powerful mechanisms that decide who gets to breathe in the global credit ecosystem. Liquidity isn't just a buzzword, it's the lifeblood of the entire system, and the Fed controls the heart that pumps it. At its core, the Fed's power rests on three engines: reserves, securities, and special facilities. But this sterile term masks a colossal process that moves trillions of dollars every single day. Let's start with the first engine, reserves and securities, which come together in a process you've probably heard of, quantitative easing, or QE. Here's how it works. Commercial banks, like Chase or Bank of America, hold special accounts at the Fed, known as reserve accounts. When the Fed wants to inject money into the system, it goes into the open market and buys assets, typically U.S. Treasury bonds or mortgage-backed securities. And how does it pay for them? It simply credits the seller's reserve account with newly created electronic dollars. Think about that for a second. There's no printing press, no dramatic vote in Congress, No taxpayer approval needed. It's just a change in digits on a screen. A few keystrokes and hundreds of billions of dollars are willed into existence. That's QE. The Fed purchases an asset. Its own balance sheet expands, and in doing so, it manufactures the raw material for the entire modern financial system. The simplicity of this process hides its profound consequences. By 2014, after 3 massive rounds of QE, the Federal Reserve's balance sheet had swelled to over $4 trillion. It owned a huge chunk of U.S. government debt. In effect, the nation's central bank had become the largest single creditor to the U.S. government itself. The line between fiscal policy, government spending, and monetary policy, the Fed's actions, had blurred completely. When Congress debated budgets, the Fed had, in a way, already prepaid the bill. When the Treasury needed to issue new bonds to fund government operations, the Fed's massive purchasing power guaranteed there would always be a buyer. The idea of the Fed as an independent institution had morphed into something else entirely: interdependence. It created a feedback loop. The government borrows, the Fed buys the debt with new money, financial markets cheer the flood of liquidity, and future generations are left to figure out how to pay for it all. But creating all this money is only half the story. To manage this system and maintain the illusion of control, the Fed had to build a parallel universe just beneath the surface. This brings us to the repo market, the repurchase market. This is the critical, high-stakes plumbing that keeps the financial world from seizing up. It's an overnight funding network where banks and large financial dealers borrow cash from each other for extremely short periods, usually just one day, using ultra-safe collateral, like Treasury securities. Every single night, somewhere between $1 and $2 trillion flow through this market. When the repo market runs smoothly, liquidity feels infinite, and the financial system is stable. But when it hiccups, the entire global market trembles. We saw this happen in September 2019, before anyone was even talking about a pandemic. Out of nowhere, interest rates in the repo market spiked from a normal 2%, all the way to 10% overnight. It was like a silent heart attack inside the circulatory system of finance. The Fed had to act, and it had to act fast. Within hours, it injected over $75 billion in emergency funding to calm the market. It later created a permanent tool, the Standing Repo Facility, to prevent this from ever happening again. The message was clear: the system was so fragile that even its most basic overnight funding mechanism had to be backstopped, essentially federalized, by the central bank. Now, why is this repo market so important? Because in this world, collateral, not cash, is king. High-quality collateral, especially U.S. Treasury bonds, is the grease that keeps the gears of finance turning. Banks pledge these securities to borrow money, and then the lender can repledge those same securities to borrow more money. This process, called rehypothecation, creates long, complex chains, where a single treasury bond can be used to back multiple loans at once. It magnifies liquidity, creating money out of collateral. But here's the paradox of modern monetary policy. When the Fed does QE, it buys up trillions of dollars in treasury bonds. By doing so, it's actively removing the best collateral from the market. So, while the Fed is injecting cash liquidity with one hand, it's draining collateral liquidity with the other. It's like trying to fill a bathtub while simultaneously shrinking the pipes. Each intervention to fix one leak risks opening up another somewhere else. To manage this contradiction, the Fed created yet another piece of plumbing: the Overnight Reverse Repo Facility, or on RRP. This is essentially a drain for the system. It allows money market funds and other institutions swimming in excess cash to park it at the Fed overnight. In return, the Fed gives them a treasury bond as collateral and pays them a small amount of interest. At its peak in 2022, this facility was absorbing more than $2.5 trillion every single night. On the surface, this looked like a sign of stability, but underneath, it was a symptom of a massive imbalance. The system was flooded with cash that had nowhere to go. Banks had so many reserves they couldn't lend them out profitably, while other players were desperate for the safe collateral the Fed was holding. The Fed had become both the source and the sink for global cash, turning what was supposed to be a free market financial system into a closed loop, entirely dependent on its pipes. After the 2008 crisis, regulators introduced rules to make the system safer, like the supplementary leverage ratio, or SLR. This rule was designed to limit how much debt banks could take on, but it had an unintended consequence. It forced banks to count their ultra-safe reserves held at the Fed as part of their total assets, making it costly for them to hold the very liquidity the Fed was creating. In the market chaos of March 2020, the Fed had to temporarily relax this rule to prevent the banking system from seizing up. But when that exemption expired a year later, banks immediately pulled back from the Treasury market, causing even more volatility. Once again, the Fed was trapped by its own design. Every rule intended to create safety ended up creating a new dependency. Control demanded more control. Finally, let's look at the Fed's ultimate power tool, the dollar swap lines. These are the global lifelines that reveal the Fed's true planetary reach. During a crisis, the Fed allows other major central banks, like the European Central Bank, the Bank of Japan, or the Bank of England, to swap their own currencies for US dollars. This gives foreign banks access to the dollars they desperately need to operate. During the panic of March 2020, the use of these swap lines exploded, rocketing from just $45 billion to over $450 billion in a matter of weeks. The list of central banks involved reads like a roll call of monetary superpowers, all wired directly into one hub in Washington, D.C. When the Fed opens these valves, US dollars flood the world's financial arteries. When it closes them, entire nations can suffocate. Through these mechanisms, the Federal Reserve has become the de facto central bank for the entire planet. Yet, its governors are appointed by the U.S. President and are only answerable to U.S. law. A system with no global oversight dictates global survival. The truth is far simpler and much more powerful. It's a single institution with an $8 trillion balance sheet, the Federal Reserve. Nothing in modern markets happens independently of this machine. And today, we're going to pull back the curtain and show you how it really works. To understand the Fed's power, you have to look at the numbers from 2023. Total U.S. commercial bank reserves were around $3.2 trillion. Reverse repo balances, about $1.7 trillion. The Fed's holdings of Treasury bonds, a staggering $4.8 trillion. And mortgage-backed securities, another $2.4 trillion. Add it all up, and you get that $8 trillion figure that headlines its immense power. Every single one of these components is a policy lever. When the Fed shrinks bank reserves, interest rates rise. When it expands reverse repos, short-term funding tightens. When it sells treasuries, yields spike, raising borrowing costs not just for Americans, but for governments all over the world. To see this architecture clearly, picture a three-layer pyramid. The base layer is collateral, the Treasury bills, notes, and bonds that guarantee trust in the entire system. The middle layer is made up of reserves and the repo market, the instruments that move that collateral through the system. And at the very top, you have risk asset stocks, corporate bonds, derivatives, all floating on the sea of liquidity beneath them. When the Fed expands its balance sheet through quantitative easing, it's pushing new money up this pyramid, inflating the value of everything at the top. When it tightens, it pulls that liquidity back down, crushing everything above it. This is precisely why stock markets seem to react more to tiny basis point shifts in Fed policy than to blockbuster earnings reports or groundbreaking innovations. The pyramid might look like free market capitalism, but it behaves a lot more like central planning. This deep interdependence creates a dangerous feedback loop. Low interest rates inflate asset prices, and those rising asset prices then justify keeping rates low. It's a cycle that feeds itself. But when that loop breaks, like it did in 2022, the correction isn't a natural, self-healing process. It's administered. The Fed decides when the pain starts, how much pain is tolerable, and when it stops. Even bond yields, which were once considered the market's purest signal of risk, are now distorted. They're driven by the constant expectation of future Fed intervention. As a result, every investor, from Wall Street giants to retail traders, isn't just trading on company fundamentals anymore. They're trading on one critical question: what will the Fed do next? Price discovery has become policy discovery. Now, it's talk about quantitative tightening, or Q2. This is the reverse process. Instead of buying assets, the Fed lets them mature without reinvesting the proceeds. This shrinks bank reserves and systematically siphons liquidity out of the financial system. In 2023 alone, QT drained over $1 trillion from the system. The stated goal was to restore normal market conditions after years of easy money. But the result was widespread stress. We saw regional banks break under the weight of unrealized losses on their bond portfolios. We saw foreign lenders scrambling to find U.S. dollars. Even the U.S. Treasury market, the very bedrock of global finance, began to show signs of serious fracture. The gaps between buying and selling prices, known as bid-ask spreads, widened to levels you'd normally only see during a full-blown crisis. Primary dealers, the big banks that trade directly with the Fed, started demanding more capital buffers. Key liquidity metrics, like the turnover ratio of U.S. government bonds, fell to multi-decade lows. The financial plumbing was drying out, and the only entity with the hose was the very same one closing the valve. To mask this strain, the Fed expanded something called its Standing Repo Facility in 2022. This facility offers unlimited overnight loans to eligible dealers, but at a penalty rate. On paper, it's a tool for stability, a backstop for emergencies. But in practice, it has become a ceiling for short-term interest rates. It's a backstop so powerful that it effectively defines the upper limit of the money market. When liquidity gets tight, banks know they can always borrow from the surf. And when liquidity is loose, they park their excess cash in another Fed facility, the overnight reverse repo, or on RRP. Together, these two facilities create a corridor, a monetary pipe, through which every single dollar in the system must flow. And the width of this pipe isn't adjusted by Congress or by law. It's adjusted by a small group of technocrats, watching spreads on computer screens that few outsiders will ever see. The Fed's own weekly reports, known as the H4.1 release, revealed just how meticulously this machine operates. Take a look at the numbers from July 2023. Reserve balances were at $3.3 trillion. Reverse repos at $1.8 trillion. Securities held outright, $7.8 trillion. Loans under various facilities, about $140 billion. Every Friday, these figures shift like the tides, and those shifts dictate everything from your mortgage rate to foreign exchange flows across the globe. There's even a line item called Other Liabilities and Capital, which is often ignored. This tracks the Treasury's bank account at the Fed. When the government drains or fills this account, it can move billions of dollars through the economy practically overnight. The ultimate consequence of all this is that the United States no longer operates on a market-determined cost of money. It operates on an administered cost of liquidity. When the Fed raises rates, what it is really doing is simply paying banks more interest on the reserves they hold at the Fed. This payment, known as interest on reserve balances, or IRB, now costs the public over $200 billion per year. It's a direct transfer from the public sector to private bank balance sheets for doing nothing more than holding excess cash. Meanwhile, the Fed itself is now running operating losses. Why? Because the interest it pays out on reserves is higher than the interest it earns on its massive bond portfolio. For the first time in its history, the central bank is technically insolvent. Of course, this detail doesn't really matter, because the Fed can literally create its own capital by simple declaration. In no other institution on earth does raw power ignore basic math so completely. Yet, this entire system functions because it feeds on one crucial ingredient: belief. As long as markets trust that the Fed can control outcomes, spreads stay narrow, volatility subsides, and the illusion of stability persists. But what happens if that trust breaks? If investors suddenly start to question the Fed's ability to rescue the system without creating runaway inflation? In that scenario, liquidity would freeze instantly. And that is the Fed's ultimate double bind. To preserve its credibility, it must sometimes do the very thing that threatens the system's existence: tighten policy into fragility. Every single basis point hike is not just a monetary decision, it's a moral one disguised in technical jargon. Bankers depend on cheap funding. Politicians depend on low borrowing costs to finance spending. Consumers depend on easy credit. In this system, almost no one benefits from discipline. And so, the system naturally self-selects for constant expansion until the day it can't. That day won't arrive with a vote in Congress or a public debate. It will arrive with a sudden basis point shock that no algorithm can reverse. It will come when repo rates disconnect from policy rates, when collateral fails to settle, when foreign swap lines hit their capacity. That is the moment when the illusion of stability collapses into the cold, hard truth of its design. Because the Federal Reserve was never built to prevent a crisis. It was built to control its distribution. What happens when the referee becomes the market itself? When every price, every yield, every pulse of credit depends on an institution no one elected, and no one can fire. That is where we stand now. The Federal Reserve was created to protect the system from panic. But the longer it absorbs every shock, the more the system forgets how to breathe on its own. Trillions of dollars move at the tap of a keyboard. Decisions that reshape nations unfold behind closed doors, only to be announced later as policy. We're told it's for stability, for jobs, for growth. But stability without accountability isn't stability at all. It's just control with better branding. Each rescue, each intervention, rewrites the social contract we all live by. Think about it this way. Every dollar conjured into existence steals a fraction of value from the dollars you've already earned. Inflation isn't just some random accident. It's the invoice for all this intervention. When the Fed expands its balance sheet, it doesn't create wealth. It simply reallocates it, shifting it from those who save to those who borrow, from labor to leverage, from the many to the few. And because this whole process is wrapped in complicated, technical language, words like facilities, normalization, temporary liquidity operations, we rarely even notice the theft. Power hides best in the vocabulary of expertise. If this cycle continues, the very idea of money could lose its meaning. Once markets no longer price risk properly, once governments no longer fear debt, and once citizens no longer understand the rules of the game, the final currency that remains is trust. And that's the one thing the Fed cannot print. History gives us a clear warning. Every empire built on credit eventually ends the same way, with confidence evaporating faster than liquidity can replace it. Look at the British pound in the 1920s, or the Japanese yen in the 1990s. The US dollar today walks that same path. Not because of scarcity, but because of saturation. Too much money erodes belief. Too much control invites rebellion. But this isn't a story of doom and gloom. The tragedy isn't inevitable. There is still a narrow window where transparency can rebuild trust. A window where we, the public, demand that monetary policy be treated not as some sacred, untouchable math, but as public governance, accountable to the people it affects. Understanding how the Fed's multi-trillion-dollar machine works is the first act of reclaiming our agency. It starts by asking the simple questions that pierce through the jargon. Who profits when interest rates rise? Who gains when the markets are flooded with liquidity? Who decides which crises deserve a rescue and which ones don't? The answers aren't some grand conspiracy. They're just incentives. And incentives, once you see them clearly, can be challenged. Because beneath all the charts, the screens, and the spreadsheets lies something far more human than economics. Fear. Fear of collapse. Fear of accountability. Fear of admitting that the very structure built to stabilize has instead made volatility systemic. But fear cannot govern forever. When the next shock arrives, and the Fed will again be called upon to save the system. The real question is, should it? How many times can we outsource our resilience before we lose it completely? Maybe the most radical act left in finance isn't speculating or protesting, but simply understanding. Because understanding is the one form of power that cannot be printed away. Someone, somewhere, just lost purchasing power to fund it. And when you're told the system is too complex to question, remember that complexity is the first defense of control. You were never supposed to see this. But now, you do. Follow the incentive, not the headline. Because power is never about what they show you, it's about what they hide. If money is the language of power, then learning how it's spoken is the only way to translate freedom back into value. This isn't the end of the story. It's the beginning of seeing. The central bank no one voted for still governs the heartbeat of the modern world. But the moment the public understands that truth, even the most powerful balance sheet on earth becomes just another page in the ledger of history. Thanks for watching. If this made you think, consider subscribing for more deep dives into the systems that shape our world. See you next time.